Right now you have $500 sitting in your bank account. It has been there for a month. Nothing has changed. The number looks the same. You feel nothing. That feeling is the most expensive mistake most people make with money, because that $500 is not the same as it was a month ago. It is worth slightly less. Inflation eroded it. The price of everything around you went up by a fraction. Your $500 stayed still, which means, in real terms, in actual buying power, you lost money by doing nothing. This video is about what happens when you stop doing nothing. Specifically, what happens when you invest $500 every single month into a low-cost S&P 500 index fund and then leave it completely alone. No stock picking, no timing the market, no watching the news, just $500 every month, automatic, for 30 years. Every number in this video is inflation adjusted. That means every dollar figure you see represents real purchasing power in today's money. Not nominal numbers that look impressive but buy you less. Real money. Real buying power. What you can actually afford with it. Let's start. Day 1. You open a brokerage account. You transfer $500. You buy into an S&P 500 index fund. You close the app. Nothing happens. The market moves a fraction of a percent in either direction. Your $500 becomes $501 or $499 depending on the day. You feel nothing. You wonder if this was a mistake. It was not a mistake. But this is the moment most people quit, because day 1 feels like nothing. And they are right. Day 1 is nothing. That is the entire point. Month 1. Your first automatic investment has gone in. You have contributed $500. Your account shows $503. You made $3. You could not buy a coffee with the return on your first month of investing. This is intentional. Compound interest does not care about month 1. It is building a foundation you cannot see yet. Year 1. You have contributed $6,000 of your own money. Your account is worth $6,228. You made $228 above what you put in. That is a 3.8% real return on your money in the first year, after inflation. It does not feel like anything yet, but something important happened this year that you cannot see in the number. Your money started working, quietly, in the background, without you doing anything. Compare this to what happened to the same $6,000 sitting in your savings account at 0.5% interest. After inflation of 3%, your real return was negative 2.5%. Your $6,000 in savings actually lost $150 in real purchasing power. The number on the screen stayed roughly the same. But what it could buy you quietly shrank. This is what your bank does not tell you. A savings account at 0.5% in a 3% inflation environment is not saving your money. It is slowly destroying it. Year 3. You have contributed $18,000. Your investment account is worth $20,041. The market has added $2,041 on top of your contributions. The number is starting to look real. You can feel it now, but you are still in the early phase. The compound engine has not warmed up yet. Year 5. You have contributed $30,000. Your account is worth $35,972, nearly $6,000 above your contributions. A 20% gain on top of everything you put in real inflation-adjusted terms. Here is where something important starts to happen. The growth rate of your portfolio begins to exceed your monthly contribution. The $500 you add each month is becoming a smaller and smaller percentage of your total portfolio. The money already in there is starting to do more of the work than the money you are adding. Year 10. You have contributed $60,000. Your account is worth $87,052. The market has given you $27,052 on top of your own money. Nearly half again as much as you contributed, and the pace is accelerating. This is the year that feels different. $87,000 is a number that changes things. It is a house deposit. It is a car. It is a year of not working. And you got here by setting up an automatic transfer and not touching it. If you had kept the same $60,000 in a savings account at 0.5% over the same 10 years while inflation ran at 3%, your real purchasing power would have declined by approximately $14,000. The number on the screen would show roughly $63,000. But in real terms, in what that money can actually buy, you would have lost ground every single year. The stock market did not guarantee you wealth, but the savings account guaranteed you a slow, invisible, mathematically certain loss. Year 15. You have contributed $90,000. Your account is worth $163,847. The market has added $73,847 on top of your money. For the first time, the growth exceeds your total contributions. The market has given you more than you put in, and you are only halfway through the 30 years. Something else happens at year 15. The monthly compound growth on your existing portfolio, roughly $1,000 per month at this point, exceeds your $500 monthly contribution. The machine is now feeding itself. Your contributions are almost irrelevant. The money that is already invested is growing faster than anything you add. Year 20. You have contributed $120,000. Your account is worth $291,614. The market has added $171,614. More than your total lifetime contributions in pure growth sitting on top of what you put in. $291,000 in today's purchasing power. Real money, inflation adjusted. The coffee you can buy with this money is the same coffee you can buy with $291,000 today. Not a nominal number that sounds big, but buys you less. Actual real wealth. Year 25. You have contributed $150,000. Your account is worth $498,613. You are approaching $500,000 in real terms. The growth alone, $348,613, is more than twice your total lifetime contributions. At this point, your portfolio is growing by roughly $3,000 per month in real terms. Your monthly contribution is $500. The market is contributing $3,000. You are almost a passenger now. The compound engine you built by doing nothing for 25 years is running itself. Year 30. You have contributed $180,000 over 30 years. Your account is worth $832,683 in today's purchasing power, fully inflation adjusted. The market gave you $652,683 on top of your own money, 3.6 times more than you contributed yourself, for doing nothing except not touching it. If you double your contribution to $1,000 per month, the numbers do not double. They more than double. At $1,000 per month for 30 years, your inflation-adjusted portfolio reaches $1,665,366. The same 30 years, the same index fund, double the monthly contribution, produces $1.6 million in real purchasing power. And if you had kept that same $180,000 in a savings account at 0.5% while inflation ran at 3% over 30 years, your real purchasing power would have declined by approximately $55,000. The number on the screen would show around $195,000. But in real terms, you would be significantly poorer than when you started. The savings account did not protect your money, it just hid the loss in plain sight. Now here is the number that should concern you most. The average American starts investing seriously at age 31. If instead they had started at 21 with the same $500 per month, the difference at retirement is $558,000 in today's money. 10 years of starting earlier is worth more than 20 years of contributions that come later. The first 10 years of compound growth are the most valuable years you will ever have. And most people spend them convinced that $500 a month is not enough to bother with. The S&P 500 has returned an average of 10.5% per year nominally since 1957. After inflation, it is approximately 7.3% real annual return. It has never permanently lost value over any 20-year period in its history. It has crashed. It has recovered. It has compounded. Every single time. This is not a guarantee. Past performance is not a promise. But 67 years of data across wars, recessions, pandemics, financial crises, and presidential elections suggests a pattern that is difficult to argue with. There is one thing that destroys this outcome completely, and it is not a market crash. Markets crash and recover. The thing that destroys compound growth is selling when the market falls. Every investor who sold in March 2020 when the market dropped 34% locked in their losses and missed the 100% recovery that followed over the next 12 months. The people who did nothing, the people who felt nothing and kept their automatic transfer running, came out ahead of everyone who tried to be clever. The strategy is boring. An S&P 500 index fund, $500 a month. Automatic. Untouched. For as long as possible. Platforms like Fidelity, Vanguard, and Schwab all offer low-cost index funds with expense ratios under 0.1%. That means for every $10,000 you have invested, you pay $10 per year in fees. Not 1%, not 2%, $10. The math does the rest. So the next time you look at your savings account and see that 0.5% interest sitting there, remember that inflation is running at 3%. Remember that your real return is negative 2.5%. Remember that every month that money sits still, it is buying slightly less than it did the month before. And then remember what $500 a month becomes in 30 years. $832,683. In today's money. After inflation. From $180,000 of your own contributions. The market did not ask you to be smart. It did not ask you to time anything. It did not ask you to watch the news or pick stocks or understand interest rate policy. It just asked you to start, and then to do nothing.